Okay, let's unpack this. We're diving into a really fascinating dynamic today. It's one that kind of perfectly shows this collision between, future tech demand and just raw market mechanics. We're seeing a pretty significant signal emerging from a period of consolidation. We're talking about a single-day move where a stock jumped 8.42% on heavy volume.
Yeah, and that's not just, random volatility. It feels like the early rumblings of a very deliberate shift.
It really does. Today is focused completely on OKLO Inc., that's ticker OKLO, and it's based on this compelling analysis report titled, Don't Miss the Boat. OKLO is setting up for a massive short squeeze.
A pretty direct title.
Very direct.
Yeah.
And our mission here is to basically act as your guides, to distill the technicals, the fundamentals laid out in that document so you can really understand what might be fueling this whole setup.
And that price action you mentioned, it just sets the stage perfectly. I mean, when a stock like OKLO closes at 77.80, puts up that kind of gain.
Right.
And critically, the buying pressure continues strong into the after-hours market. That really confirms that, bigger money, institutional interest is driving the move.
That momentum is so crucial because, as this analysis points out, the core story here is this impending market collision. On one side, you've got shorts who place a huge bet against the company.
A very big bet.
And on the other, you have this undeniable accelerating narrative of the AI energy crunch.
Yeah.
The report basically says OKLO is positioned right at the intersection of both of those forces.
To really get why a short squeeze could be so explosive here, we first have to understand the fundamental strength. The reason why long-term money would even want to buy and hold this.
Okay.
And the fundamental bull case, according to the sources, is all rooted in the future of artificial intelligence. It's actually pretty simple. You can't scale AI without massive, guaranteed, and reliable baseload power.
The scale of that demand is just. It's hard to wrap your head around. We're not talking about powering a small office building here.
No.
These AI data centers need power in the gigawatts, not kilowatts. I mean, that's like powering millions of homes.
And that's exactly why the current energy grid just struggles. The analysis is very clear on why traditional renewables, solar and wind, are fundamentally not enough for this job.
Because they're intermittent, right?
Exactly. They're intermittent. You can't just pause the training of a massive foundational model because the sun set or the winds start blowing. AI needs baseload power. That's consistent 2047 generation that doesn't care about the weather.
And this isn't some fringe theory either. We're seeing validation from the biggest names in the industry. Jensen Huang from NVIDIA, for example, has been really vocal that nuclear is essential for future data centers.
And when the CEO of the world's most dominant AI chip company says that's the solution, well, the investment world pays very close attention.
So that industry validation leads us directly to OKLO's specific solution. The company is positioning itself, and the report uses this phrase as the Tesla of nuclear.
It's a great analogy.
Wait, I like the analogy, but I have to push back a little. Can a nuclear plant ever really be a Tesla product? I mean, Tesla is about speed, mass production, familiarity. Nuclear is. It's slow, it's heavily regulated. How does Oak solve that?
That's a great question, and it's the critical distinction the report makes. The Tesla comparison isn't about, a car in every driveway. It's about disrupting the distribution model. It's about modularity.
Okay.
OKLO's product, the Aurora Powerhouse, uses fast fission tech. It's designed to be small, scalable, and this is the most important part, dropped directly on-site at a data center.
So it solves the transmission problem.
It completely solves the bottleneck of the traditional centralized power grid. It's a decentralized power source for a decentralized computing need.
Which brings us to maybe the most compelling fundamental argument, the Godfather backing. Sam Altman is the chairman. You can't talk about the AI ecosystem without talking about him.
Absolutely not. The market sees Altman as the ultimate insider. The core belief here is that given his position and the massive energy needs of his own ventures, he's going to funnel contracts and opportunities from that whole AI ecosystem straight to OKLO.
In a new sector like this, where contracts are everything, that's seen as an incredible advantage.
It's perceived as invaluable.
But doesn't that create a risk? I mean, relying on one person, if his focus shifts or if the regulatory hurdles are just too much even for him, does that whole bull case just fall apart?
That's a legitimate, critical question, and it's the weakness the shorts often point to. But the analysis offsets that with maybe the most important piece of fundamental data, the cash runway.
Let's spend some real time on this, because whenever you hear pre-revenue nuclear company, the first thing you think is insolvency risk. How does the report deal with that?
So the shorts are basically betting on two things, time and cost. They assume the regulatory process will drag on forever and that OKLO will just run out of money before they can get to commercialization.
A common story.
A very common story. But the analysis points out OKLO has about $1.2 billion in cash on its balance sheet.
$1.2 billion. That's a massive war chest. Why is that number specifically a short thesis killer in the nuclear space.
Because nuclear development isn't measured in quarters, it's measured in years. That $1.2 billion gives them the financial runway to survive the long, unavoidable NRC regulatory and licensing process.
Got it.
It completely takes the risk of, a cash crunch or bankruptcy off the table. It forces the bears to bet only on regulatory failure, not financial failure.
So the fundamentals give the company a solid foundation, a compelling long-term story driven by AI demand and some very powerful insider backing. So with stability established, let's pivot. Let's look at what lights the fuse, technically, the numbers behind this squeeze setup. Here's where the market mechanics get really interesting.
The analysis describes the current chart setup as a classic coil pattern. You can think of it like a spring that's being compressed and compressed over time. This pattern forms after a stock has been going sideways for a while. And during that time, two things happen. First, short sellers see that stability, and they pile in thinking the stock has hit a ceiling.
And
Second, the weak hands, the retail investors who bought at previous highs, they finally get frustrated and sell out. That creates this high-pressure situation where institutions and shorts hold most of the shares.
And the data shows this spring is extremely compressed. The report says short interest is hovering around 16 to 20% of the public float,
which translates to over 20 million shares that have been sold short. They have to be bought back eventually.
That is what they call a crowded trade for the bears.
Oh, absolutely. Anything approaching 20% is a very vulnerable position. If the stock turns against them, the sheer volume needed to cover becomes a self-fulfilling prophecy. It just pushes the price up.
And the most critical metric here is days to cover, or DTC. The report notes the DTC ratio has crept up to about 3.5 days. Let's break down what 3.5 days actually means for a short seller who's starting to panic.
DTC is just an estimate. It's how many trading days it would take for all the short positions to be closed out, assuming average daily volume. If it's 3.5 days, it means if a panic starts, there just isn't enough liquidity.
There aren't enough shares available to buy immediately.
Exactly. The volume isn't there. If those 20 million shares suddenly need to be bought back, the short sellers are forced to bid against each other aggressively, which is what drives the price vertical.
In other words, the first few who panic and cover get out okay. Yeah. Everyone else is looking at rapidly bigger losses.
Precisely. The pain is exponential. The price jumps on day one, which makes the remaining shorts face even bigger losses on day two, which causes more panic buying. And on it goes. The DTC ratio is the engine of the squeeze.
And then you add the stock's own volatility to the fire. The report points out OKLO has a high JETA. A daily move of 10, even 20% is. It's kind of normal for this stock.
And that volatility is a short seller's worst nightmare. It means a single catalyst, a contract announcement with a hyperscaler, a positive update from the NRC. It would put the entire short position instantly underwater.
With losses mounting so fast they couldn't get out in an organized way.
No chance.
Which brings us back to that 8.42% move that started this whole deep dive, the warning shot. The report had a crucial insight here. A stock with this much short interest jumping over 8% in one day.
With no specific company news.
Right, with no news. That often signals that some shorts are starting to quietly cover just out of fear.
It's the institutional version of hedging your bets. Some of the smarter funds saw the stock holding that floor, realized the fundamental story wasn't going away, and decided to cut their risk before things got out of hand.
And their covering is them buying shares.
Yes, and that buying creates the initial push, which then encourages the next group of shorts to panic and cover, and that's how you get that positive feedback loop started.
That makes the technical chart analysis absolutely vital right now. We know the fuse is lit, but where does the analysis say we are on the launch pad?
The report identifies some very clear price levels, which kind of gives us a roadmap. First, the stock established what it calls a rock-solid floor between $70 and $72.
Okay, so that was the support level.
That's where high-volume buyers just kept stepping in again and again. It became a really reliable psychological support level for anyone who was long.
And Friday's aggressive move.
That was essential. It punched right through the key $75 resistance level. That move confirmed a major shift in momentum, signaling that the buyers, maybe some of those short coverers, were taking control.
So if we're just under 78 now, what's the critical breakout signal the analysis is watching for? What's the one that confirms the squeeze is really on?
That number is $80. The analysis states that if the stock breaks 80, the technical confirmation is complete. The move shifts from accumulation to potentially explosive follow-through.
The report's phrase was, the boat is leaving the dock.
That's the one. Once 80 is cleared, the boat is leaving the dock.
And once that happens, the technical picture gets really interesting because the report talks about a massive air pocket up ahead.
Yes, the term air pocket just means there's a lack of overhead supply. Think of it like a clear highway after a huge traffic jam. The analysis sees a gap between $80 and $100.
Meaning very little resistance.
Very little resistance from people who bought higher and now want to sell to break even. Stocks tend to fill the gap quickly, and the idea is that clearing $80 sets the stage for a rapid run straight toward triple digits.
And for perspective, we should remember the historical context here. The report reminds us the 52-week high was $193.84.
Exactly. So at the current price, the analysis points out you're effectively getting in at a 60% discount from its previous all-time high. That gives you a sense of the massive theoretical upside if this AI energy story really plays out.
And we have to stay impartial and acknowledge the pre-revenue risk. But setting that aside, what are the professional analyst targets the report cites that sort of back up this potential move?
Well, the targets reflect the enormous scale of the opportunity here if OKLO succeeds. The consensus target cited is around $102.87.
So breaking that $100 psychological barrier.
Yep. But the bull case target is set much higher at $150 plus.
Wow. So that range implies a potential move of anywhere from, 32% to over 90% from current levels?
Yeah.
All driven by this combination of technicals and fundamentals.
Those numbers certainly explain why the report's conclusion is that this is, quote, arguably the most explosive stock in the energy sector right now. The setup is just textbook.
This has been an incredibly detailed look at a very specific market alignment. We've hit the short squeeze mechanics, the fundamentals, the targets. Let's bring it all home and look at the final verdict.
The report doesn't leave much room for ambiguity. That $77 level is presented as the line in the sand. The price action confirmed the momentum shift. You have high short interest, you have the AI demand narrative. All systems look ready for a big move up.
And the analysis gives a very direct action plan. The verdict is quoted exactly as, buy the dip, set stops at $70, and watch for the squeeze to 100. Don't miss the boat.
Yeah.
But let's step back from the trade for a second and think about that label. Arguably the most explosive stock in the energy sector. So what does this all mean beyond just a short-term squeeze?
It means that while the short-term game is clearly that technical squeeze to $100, the long-term viability, the real reason for that $150 target, it all depends on something much bigger.
And that is?
It's speed and execution. The report highlights this exponential AI energy demand, right? OKLO's future rests entirely on how fast they can execute.
Speed, even with someone like Sam Altman behind them.
Yes. How quickly can their Aurora powerhouse scale from a plan on paper to an actual deployment? And maybe more importantly, how fast can they get through all the complex regulatory hurdles to actually meet that gigawatt demand before a competitor does?
Or before a traditional utility comes up with an alternative.
Exactly. That race to market, which that $1.2 billion war chest is supposed to help them win, that is the ultimate question. It's what will decide if this is just a quick, explosive trade or a defining long-term investment in the entire future of AI infrastructure. And that's really the question you should be thinking about long after any short squeeze is over.